G20 finance ministers and central bank governors are meeting in Cape Town today and tomorrow. This is the second round of G20 finance meetings since December. High public debt is likely to feature prominently on the agenda, and the US will continue to remove itself from the discussions. The country's Treasury Secretary Scott Bessent will be absent from this gathering. The National Treasury's Director General Duncan Peterson kicked off today with what African countries are looking ahead to in this year's summit. Here are those insights.
As we've indicated before, South Africa has signaled a strong and keen intent to review the operational processes of the G20. Last month, the G20 began its 26th year of operation. However, the operational processes of the G20 have rarely been reviewed. In the coming months and following the discussions this week, the South African presidency, working with the G20 membership, will for the first time conduct a review of these processes and consider how to improve and strengthen them. We will also discuss various other opportunities for G20 engagement this year. One of the issues of importance to the world's poorest and most vulnerable developing countries is the issue of financing for development. Today we will discuss the Financing for Development Conference, which is happening in July this year, and how the G20 finance track might consider engaging with this process. We will also hold a very important discussion this week on the challenges and constraints to growth in developing countries, including African countries.
Treasury is confident South Africa will exit the Financial Action Task Force's money laundering greylist by October. That's after the organization stated that there are only 2 items left to be addressed. SA was greylisted in 2023, and the country and the FATF agreed on an action plan that set out a list of 22 flaws in the country's financial system that needed improvement. Being greylisted dents a country's reputation and raises transaction costs as it increases the due diligence required to meet FATF requirements. In company news, Sasol has skipped paying an interim dividend. That's after the petrochemical firm reported a 31% decline in half-year profit. That's as a result of a fall in oil prices and lower sales volumes during the period. Looking ahead, the company says the macroeconomic and operating environments are expected to remain challenging. Prosus is set to acquire JustEatTakeaway.com. The transaction is worth 4.1 billion euros. That equates to about 79 billion rand. The deal will be funded through the Naspers owned company's existing cash resources. It's hoped the move will allow Prosus to create a leading food delivery platform in Europe. Anglo-American Platinum has halted operations at its Dumela mine in South Africa. That's after excessive rains caused flooding. But the miner says this shouldn't impact production guidance. A detailed impact assessment and recovery plan is underway. Dumela produces about 10% of Amplatz's monthly metal in concentrate. Altron is expecting a profit bump. The IT service management firm's full-year headline earnings per share from continuing operations are forecast to be at least 40% higher. The business says this is supported by the delivery of improved efficiency and operating leverage across the business. Full details will be released when the group publishes results on the 26th of May. Cash Builds flagged a rise in half-year profit. The building materials retailer says its headline earnings per share could come in flat or register an increase of up to 5%. It has not elaborated on that forecast, but more detail should be provided when it opens its books next month. Further afield, business leaders in Germany urged Berlin to quickly form a new government, warning Europe's top economy could not afford to waste any time as companies suffer from high costs, red tape and rising competition from abroad. Here's more detail in this report.
German business leaders on Monday called on Berlin to form a new government swiftly. They warned that the country could not afford to waste any time. Companies in Europe's top economy are struggling with high costs, red tape, and rising competition from abroad. The country's conservative CDU-CSU bloc won Sunday's national election, paving the way for a coalition with the Social Democrats. But opposition parties hold a blocking minority in parliament over more far-reaching decisions. Germany's top companies have also long criticised the government's lack of action over energy costs. A major concern for corporate leaders is that Germany could see its economy shrink for the third consecutive year in 2025. Ethan Devitt is Chief Investment Officer at Moneta.
They want to see, I think, a leaning towards some of the shortcomings that Europe has shown relative to the US. So that would be certainly a lot more stimulus and a release of this fiscal brake, the debt brake that has been really keeping investment back. I think they want to see a focus on innovation. We know that defense spending is going to become a new norm across all of Europe, and certainly that is boosting the stock market prospects. And clarity as regards regulation and any perceived anti-business sentiment.
Despite concerns about potentially tricky negotiations over economic policy, the euro and German stocks rallied in morning trade as investors welcomed the result. The euro rose to a one-month high, while Germany's DAX stock index rose 0.7% in early trade. The pan-European stock 600 index rose 0.19%, although tech stocks slipped.
And Alibaba said it plans to invest at least $52.44 billion in its cloud computing and artificial intelligence infrastructure for the next 3 years. Let's take a look.
Alibaba plans to spend big on artificial intelligence. The Chinese e-commerce giant said Monday it aims to invest at least $52.44 billion into cloud computing and AI infrastructure over the next 3 years. Alibaba said the total investment amount is more than its spending in AI and cloud computing over the past decade. The company has kicked off 2025 as a winner in China's AI race. It's drawn investors with strategic business deals, and its stock has risen more than 68% this year. Other Chinese firms have also been investing into the AI sector. Sources have told Reuters TikTok owner ByteDance plans more than $20 billion in capital expenditure for this year. They added much of the spending will be centred on AI.